Okay, ladies and gentlemen, welcome to Spread Trading 101. In this video, we're going to give you an introduction to spread trading and how the FIT platform gets you there faster. Now, if you're an experienced trader or you've already traded spreads or starting to trade spreads, make sure you check out our future videos on more sophisticated spread strategies. But for this one, we just want to give newer traders who understand the basic directional concepts of trading but have never traded a spread before. So our goal here is introduce you to the benefits and give you a learning path that will help you really take advantage of our spread functions in the platform. Now, take a look at these two charts. If you were trading any one of them, let's separate them. If you're trading any one of them, this is the NQ, or the NASDAQ futures contract. This is the ES, or the S&P futures contract. If you're being honest with yourself, if all you're looking at is price and price action, there is no predictive value there, because this, without any context, is just past history. But if I were to put them together, this gives you an idea of the relationship between the two. So if I trade the relationship between them instead of one alone, something different shows up. That's spread trading. And if you've never done it, this video is your on-ramp. So when you're spread trading, one thing you need to keep in mind is you are not trading one thing. This is a mistake a lot of Forex traders make. They think because I'm trading the Euro-Yen, I'm trading one thing. You're actually trading two things. If you go long, for example, the Euro-Yen, you're actually buying the Euro-dollar and selling the yen. And we're going to show you in another example how that works. But before we do, let's take a look at the platform. Spread trade is simple in concept. Instead of betting on the direction of one instrument, you're betting on the difference in performance between two related instruments. It's very important to understand. When you spread trade, you want to trade two related, or as they say, correlated instruments. Okay, you also want to trade two instruments at a period of high co-integration. And we'll get into that another time, but for now, what you want to know is you're trading two instruments that have a similar relationship. And as you can see over here, we've laid a lot of that out for you. So if you want to trade the ES against the NQ, S&P against NASDAQ, S&P against the Russell or the Dow, if you want to trade the 2-year against the 10-year, 10-year against the 30-year, it's actually a 20-year, but still called the 30-year, the 5-year against the 20-year, the euro against the pound, you want to make sure that they're related instruments or correlated instruments. Soybeans and corn, correlated. Soybeans and soybean meal. Soybean oil, crude oil, natural gas. You get the picture. Gold and silver, these are correlated assets. These assets are less correlated, but we included crude oil against gold for reasons that we can get into in the more advanced training. The main thing you want to understand is you're trading two correlated assets, and if leg A, each one is called a leg, the S&P 500 would be considered one leg, the NASDAQ would be considered another. So if you trade CFDs, you can accomplish the same thing. You would just use CFDs. If for some reason in your country you can't trade the futures contracts, it's the same principles. The benefit to you is that this is the dog that wags the tail. Remember, the futures moves the CFDs. Okay, the CFDs are based on the futures contracts, not just the underlying. But so traders do this across almost every asset class. All right, ES against the NQ, yield curve spreads, FX futures, so on. Now, so why would you trade a spread instead of just picking direction? There are three reasons. One, you generally strip out a lot of market noise. Take a look down here. This is the actual spread. So when you see the red or the green, you see the direction and the movement of the actual spread, not individual outrights. And as you can see, let's take a look right here, or even up here. I'm going to get rid of some of these because it's getting noisy. Let's just take a look at the 1 day. I'll tell you what, let's look at the 3 day. This is this gives you a good idea because most spread trades last longer than a day. Right? Look at all this noise. Look at the NASDAQ. Up here, look at the P&L, was 2817, and it popped from a positive 2817 let's just call it 2,800, down to a negative 1,000. And over here, you had some volatility, but the spread basically told you to go short. So the most drawdown you might have had here was about $116. Here you had a lot of volatility. Like I just said, what's that? 3,000, 3,800, all the way down to 1,300. That's over a $4,000 swing. Okay, $4,000 differential in P&L. So you can strip out a lot of that market noise because you're not trading one thing, you're trading the relationship between the two. The second reason is you can find opportunity where there's no clear direction. So as you can see here, the both instruments, both the ES and the NQ, broke above the zero line and they looked like they were going to break apart. Short the ES and long the NQ, this would have been my trade. And as you can see, it was a winner. Why? Because I lost money on one. You typically lose money on one of the legs. In this case, it was the ES because I shorted the ES and I went long the NQ. So as you take a look over here to the right, the NQ over this time period, when was this? July 8th to July 9th at 1 o'clock. Let's look over even here. July 9th at 9:45 in the morning. It was at 12,769. So this was up about 12.7, and the ES was only up, what was that? About 2,700. All right, so I lost 2,700 on the ES because remember I went short, but I went long, and I made 12.7 over here. Okay, so I made about $10,000 on this trade, and it was just much less noisy. What we want to demonstrate is you can find opportunity where there's no clear direction. Let's look over here. Okay, we didn't know what was going on, but we knew the relationship between the two was such that you should have been going along the ES and short the NQ, because take a look, this profit was made because we were short the NQ. The other reason is because you have defined structural risk. Because you're long one leg and short another, spreads tend to have more mean reverting behavior than outright positions. When the NQ gets too far away from the ES, generally it has to find its way back home. Take a look. It diverted. There's a deep divergence away from home, but then it came back home. It did it again. Let's look at another one. Did it again here. Too far from home. That's the expression I like to use. It wants to come home. Too far from home, the NQ, it wants to come home. So you're trading the relationship between the two, and you can clearly see which one I like to use the term, the muscle behind the move. And when the relationship fails, for example, if you went long here, if the relationship fails, it gives you a straightforward place to perhaps get out. So for example, if you went long the spread here, didn't take your money off the table, which was $2,400, and it started breaking down, you can just close your position. If you waited too long, you close your position as soon as you break that zero line, because that means there's a structural breakdown in that spread. We're looking for the structural, you're too far from home, because I'm looking at the relationship between the two. Guys, if you think about it, everything you do is based on relative value. Right? If you buy Microsoft instead of Apple, you did that because you assessed a higher relative value to Microsoft. If the shoes on your feet are New Balance instead of Nikes, that's because you applied a higher relative value to New Balance than Nike. Everything we do is based on relative value. The home you live in, the vehicle you drive, the clothing you wear, everything is based on a value that's assigned to it. It's the same in investing. It's the same in trading. Nothing is cheap or expensive on its own. It's only cheap or expensive relative to the value of something else. Now, this might be elementary if you're already spread trading, but again, we're talking more to the newer traders who haven't spread traded or are considering spread trading. It's really a very professional way of thinking. And if you think about it, every fund, if you've ever turned on the financial news, you might have heard the expression sector rotation. So let's say they were in the industrial sector and the asset manager made a lot of money. They might consider rotating into, say, technology. So they're constantly, even sector rotation is a decision based on relative value. Why do newer traders find spreads intimidating? Spread trading has a real learning curve. You have to understand ratio. You have to understand how many contracts of each leg you need, so you're comparing dollar for dollar, not just price. You have to understand which pairs actually have a real structural relationship versus two random or poorly correlated instruments that have to just happen to correlate for a month. Okay, you want to avoid that. That lends to recency bias. And you have to learn to read the spread itself as its own instrument with its own trend, its own extremes. It takes a little time to familiarize yourself with. We handle all the math, all the plotting, so it's easy. You see a probability of a mean reversion. You can identify it and measure it and know whether or not there's a high probability of this, okay, diverging or expanding, or this mean reverting. All right. If you're new to this and have an interest in it, send us an email to info@fittrader.io and let's have a conversation about whether or not it's appropriate for you.